Hi, I'm Adam Thurgood, Chief Investment Strategist at Hightower Las Vegas, and I'm joined by Rayna our Head of Portfolio Management. And wow, what a crazy 6-7 weeks it's been since the last time we were on camera. You know, we met about 2 months ago and recorded a video where asset prices were doing great. Precious metals had ripped higher, had a little bit of a pullback. International stocks were performing well, and there was a lot of positives in the world. And then missiles and bombs started flying at the end of February, and now we're staring at a much different situation that takes a lot of deep analysis and deep thinking to try and figure out where it goes from here.
Yeah, the saying goes, there's weeks when decades happen, right?
Yeah.
I think it's been one of those periods. So I think that we should look at a chart of how asset classes were performing before, in the lead up to the war and the few months beforehand. Obviously, precious metals were the star of the show for quite a while. We did see quite a bit of volatility, but still the trend was very strong and up and to the right. Something interesting is energy stocks. So actually, the EIA, the International Energy Agency, kept saying that we have record surplus in oil, which indicated that storages should be filling up, but they weren't really filling up. And despite that, energy stocks started to surge in the last couple of months. So I think that you could make the case that they were pricing in the geopolitical risks ahead of time. And we're going to discuss how they did after the war broke out. But we also had international markets outperform, and the laggard was really the US stock markets and major stock indices. So now we are, after the war, we have to decide, do we think that those trends are still in place, or are we in a new normal?
Yeah, and a lot of that will depend on what happens in the Middle East, because the Strait of Hormuz is a massively important choke point for the global economy, not just for energy, but for a lot of other things. And volume through the Strait of Hormuz has absolutely collapsed. If you look at this graphic, you can see that it basically went from a robust flow every single day to almost nothing. Now, this matters for a lot of reasons. The global economy is reliant on so much that comes through the Strait of Hormuz. About 20% of the world's energy comes through the Strait of Hormuz. About a third of its seaborne fertilizer comes through that same stretch of water. And man, having a shortage of fertilizer at this point of the year is extremely problematic.
During planting season,
yeah,
in a lot of the world. Yes, that's very concerning. And you see, it's one thing also for prices to go up, and it's another thing for you to be facing shortages, like some places are facing right now, because that means less food overall. And you see farmers starting to adjust and plant different crops, which of course reverberates through the whole supply chain, and it's going to eventually impact farm animals as well. And the whole cost basis discussion around food globally, on a global scale. So I don't think you can really understate the impact a closure of the Strait of Hormuz has on the global economy. And we haven't even mentioned helium, which is a component of chip production.
Yeah. Not to mention aluminum and sulfuric acid, which is used for metals extraction and so on and so forth. There's so much that comes through the Strait of Hormuz that is critical to the global economy. Now, you may have heard people in casual conversations say, well, at least the US is insulated from this because we're a net energy exporter. That's true. We do export more than we use. However, the United States imports a bunch of heavy sour crude because that's what our refiners are built to process, and we produce a bunch of light sweet crude. So we're kind of doing an energy swap with the world, where we're sending some of our production abroad to get the kind of oil that we need for our refiners into the United States. Now, granted, a lot of that comes from Canada, but we're not immune to a global market and the pricing mechanisms of that global market.
Absolutely. And I think that a great way to illustrate is to just look at the chart of the WTI curve, the West Texas Intermediate Futures curve.
Which is an oil-related curve.
Yes, which is oil, crude oil exported through West Texas. So here in white we have the current curve. In pink we have what it looked like right before the ceasefire was announced, and then in green it's the normal shape of the curve, the way it looked like right before the war broke out. So we can see that the big shift really happened in the front end, where like the prices in the next month or 2 months out really skyrocketed. And that really reflects shortages and need for supply more than anything else. A lot of people are trying to say that because the curve normalizes later on in the year, next year, that means that the market is pricing in a return to normal, which is not exactly how futures work. This is more informative on current conditions and the fact that we need supply right now, and that's for the U.S.
Yeah.
So after all, even though we are probably not going to face shortages, this is a global market, and the price is going to change and affect us as well.
And it's already affecting us. I mean, I had a record fill up of my gas tank last week, which was annoying, but it's not changing my life. For most of the people that are watching this video, the price of gasoline is not going to change your life. However, for a decent chunk of America, it might be the difference of what kind of protein they put on the dining table. So this is going to have repercussions for the United States, even though we're somewhat insulated from the actual shortages.
Yes, there's definitely places that are more vulnerable to this than others, and the U.S. is one of those that is a little bit more resilient, but still prices are going to shoot up for us as well.
Yeah. Now, some places that are highly dependent on the flow of specifically energy from the Middle East are places in Asia, South Korea, Japan, so on and so forth. And we went into the year with very bullish views on those countries. They were up a lot, and we actually took some of our exposure down to be a little bit more defensive, because we don't know if they're going to end up getting all the energy that they need. And you know, we always say it's the Gav call saying, one of our research providers, that economic activity is nothing more than energy transformed, and if you don't have the energy, then you don't have the economic growth. However, when we look at what is happening in current markets, they're not really pricing in much pain.
It's a little bit of a head scratcher, right? Like, especially when it comes to energy stocks. At first they went up significantly. After the ceasefire was announced, they've tapered down their gains. I think partially that's because a lot of the geopolitical risk was priced in ahead of the war breaking out. But then we had some pain in international markets. Gold really took a hit in a significant way, and I think that's largely because when you take down risk across the board in a portfolio, gold is a smaller market, so it's impacted disproportionately compared to other bigger markets like the US stock market. And of course, there's this view that we are a little bit more insulated than other areas in the world. And then also we should talk about earnings expectations.
Yeah, but before we get there, it is remarkable to me that the S&P 500 is higher than when the war started, because it's really hard to make a case that the world is a better place than it was on February 27th, or at least economically there isn't as much, global problem that we have to worry about. So it is a bit of a head scratcher. But I think that potentially it could be because of expectations being so robust in the U.S.
Yeah, and then when you look at analyst expectations for companies, for the S&P 500, for example, well, we have this chart where we look at earnings growth expectations currently, and then 12 months out, 24 months out, and 36 months out. And earnings are expected to continue to grow as well as sales, and that has even increased since the war started. But really what's happening underneath the surface is energy company earnings expectations are shooting up because of the high energy prices, but the rest of the markets, the rest of the analysts are just in a wait and see mode. So they're not revising their earnings estimates quite yet because they want to see how long this is going to persist. I mean, we keep thinking it's going to end any day now. A lot of commentators are saying that the president is suggesting that's going to be the case. So it's hard for analysts to really revise their earnings for a 12-month horizon going forward if there's just complete uncertainty.
It seems a bit internally inconsistent, though. If energy prices and energy earnings are going up quickly, that there won't be some margin compression for the rest of the economy.
I think we can expect for those earnings to be revised once we have a little bit more of an indication what kind of scenario we're going to be facing going forward.
Yeah. Well, and speaking of scenarios, when we try to risk manage the situation, we want to look at the scenario set, and you could come up with hundreds of different scenarios, but to us there are three main scenarios that could play out, and they're all very different. And the first one is basically that you could see a situation where we kind of resolve the issues, we get the all clear, oil prices start to come down, maybe they don't fall all the way back to that $60, $70 range, but they substantially come off from where they are today, and that relieves some of the inflationary pressures, which then lets the Fed lean into rate cuts, and it would be bullish for stocks. I mean, I could see the stock market rising 10% globally to new all-time highs if that scenario played out. And it seems like the market is pricing in this scenario as the most likely at this point in time.
Yes, absolutely. When you look at the other scenarios, again, like it just is a matter of timing as well as persistence. And for example, we can look at what if we have a on and off, on again, off again scenario. That's when we could expect for oil prices to stay about $80 to $100 a barrel. We could see a lot more pressure on the Federal Reserve. They wouldn't be able to cut interest rates in that environment. And then slowly, you're going to see earnings expectations being revised lower, one after another. And you could expect for global stock markets to take a hit as well, including the U.S. stock market.
Yeah, in this second scenario, I think you could see markets fall 10 to 20% simply because we can't get a full resolution. The geopolitical risk remains high, the disruptions to supply are on again, off again, and it just creates a mess for the global economy. Not catastrophic, but just messy. Now, the third scenario is far worse. That's where we end up with something that looks more like today's situation, where there just is no flow of goods coming from the Middle East. And in that scenario, oil prices could go well above $100 a barrel. There would be shortages of things like jet fuel, fertilizer that would persist and create problems, not just in terms of price, but in actual shortages. And if you have too many energy shortages and too many goods shortages, you just have to shut things down. So you could see the global economy really take a hit if this continues in its current form for much longer.
Yes, this is really the scary scenario. It's where the Strait of Hormuz remains closed for an extended period, and it's not a very high probability, but the longer we're seeing this disruption, the more likely it gets. And this is where you see demand destruction. And we should talk about what demand destruction is. That's not something that markets could simply look through and anticipate to be resolved quickly, because that's when you get a restaurant closing down because they cannot get natural gas to fire their stove, or the prices just don't make sense anymore. The input costs are way too high and the customers are no longer willing to pay that. So you could see companies literally like closing down or cutting their earnings expectations in half, or in 30% cut to your earnings expectations. That's something that you could just disregard because you think that it's going to be resolved quickly in the future. So it's again, like, very hard to assign any sort of probability, but you cannot just disregard this. And still, you shouldn't be too apocalyptic about it as well.
I mean, if you look back over history, Marco Papich wrote a great book called Geopolitical Alpha that basically showed that you should fade geopolitical risk. You should look through it. You shouldn't really adjust your portfolio because almost always it doesn't matter. This is a unique environment because it's actually affecting the physical markets. We may not have the goods that we need in order for the economy to function. Now, the probability of this continuing for a long period of time seems extremely low, simply because policymakers and politicians would have to be morons to let it go too long. they have to have people in their cabinets that understand these ramifications. But it's gone on for now 6-7 weeks, which was sort of a cutoff point for a lot of geopolitical analysts and oil analysts and energy analysts to say we're going to see an air pocket where there simply are not enough, barrels of oil for economies to function at 100%.
Yes, actually, a core thesis of that book, Geopolitical Alpha, is looking for material constraints, and I would say that third scenario is a material constraint.
100%.
So, it's something that policymakers should be looking to avoid at any cost.
Yeah.
That's why we can't assign too high of a probability unless it becomes a reality.
Well, normally when we would do these risk management exercises, we call it the macro scenario map. We lay out a bunch of different scenarios and we try to assign probabilities to those scenarios and how it would affect the different asset classes. And we never feel like we have perfect precision, but we feel like we can get a decent range of probabilities for each of those outcomes. And then, putting the outcomes together, we can get a sense of how we should position. But today we have a good scenario with, say, a 10% positive move, a sort of in the middle scenario where markets could go down 10, 20%, and then a really bad scenario where it could be way worse than that, with a very low confidence level in assigning probabilities. So we have this negative skew with uncertainty. And when this became apparent to us about 4 weeks ago, 3-4 weeks ago, we decided to take down our risk and hedge a bit because we wanted to protect some of the gains that were in place by being exposed to international and energy and precious metals. We were in a great spot at the end of February. We were up double digits across many different strategies, and we wanted to protect some of those gains, so we took risk down.
Yes, and as Howard Marks says about risk, there's many things that can happen, but only one will. So when you risk manage, it's not like you're investing in certainties. You have to assign probabilities. Sometimes it's hard to assign a probability, but still looking at that negative asymmetry, we think it makes sense to do some more risk management moves.
Yeah, and another one of our favorites to quote is Ray Dalio, and he said, if you're not aggressive, you won't make money, and if you're not defensive, you won't keep your money. I don't think we were overly aggressive coming into the year, but we were positioned extremely well to capitalize on the trends that were in place. And so it's easier for us to be more defensive because we've had such a good run, and it makes sense to us to protect some capital. So how are we risk managing across the board?
Yeah, I think we should go through some of the risk management moves that we did in a few weeks ago. We did raise cash, and that was to reduce volatility, but also to let us have that dry powder on the side to take advantage of opportunities in the markets. We're building out our pipeline as we speak, looking at different opportunities. Where do we think the bottlenecks are going to be in the future? Even in AI, what are the future bottlenecks, the future opportunities within robotics, AI? And if some of those companies that we deem attractive in the long term take a big hit to the stock price, we are positioned to take advantage of that.
We've also increased diversification benefits by having some positions that actually should go up if the market goes down, or have very little correlation to what is happening in, say, the United States stock market. And we've been tactical. We have traded quite a bit more than we normally would have. By taking, for instance, we had a big energy overweight. We took some of that position off when oil prices got up close to $120 a barrel. We've added a bit to software because it was absolutely punished. So we have made some moves on the margin to take advantage of some of these opportunities.
Yeah, I think it's important to stay vigilant, to be nimble right now, to continue being informed on what's going on out there. And some other moves that we made were switching one commodity strategy for a different commodity strategy, which might look interesting to clients, but that's because we have benefited from oil exposure in one commodity strategy, but now we think that, if things get resolved today, maybe it's better to be positioned in agriculture because, as we discussed, with fertilizer prices and shortages, we could see those prices climbing with a little bit more certainty.
Yeah, even if the markets are open and things are fine.
Yes.
There's a lag that is bound to happen in the agricultural space because fertilizer maybe didn't make it to where it needed to make it in time for the planting season. So we have done that. A couple other takeaways that we think are pretty important are more along the lines of the longer term trends. We still believe that the shift to real assets is going to continue. There's a lot of infrastructure development planned throughout the globe, both in defense spending and just basic power grids and so on and so forth. So we think that investing in assets that are at the base layer of economic growth make a lot of sense. And defense and cybersecurity has been a theme that you've been pushing quite a bit for the past couple of years, and it has definitely paid off.
Yes, and I think that if anything, it probably would be supercharged after the war is over because countries are going to see it as a national security imperative to create resiliency, to create redundancy. We're seeing how asymmetric warfare works, where a cheap drone could really impact energy flows across the world, and countries are probably going to invest in drone technology, in anti-drone technology, in cybersecurity. And also, we could probably see a shift in the regulatory space, especially when it comes to big multinationals, information sharing, privacy policies, with AI also continuing to grow its impact across the world.
Yeah. I think if I had to sum this up into my highest probability view coming out of this is that resiliency will be a key word for a lot of different countries. When you run out of oil or you run out of fertilizer or aluminum or whatever you need to run your economy, you're going to want to have more resiliency in your supply. So we've lived in this world of efficiency where just-in-time inventories were pushed. So you would get your product the day before, so you didn't have that holding cost. I think those days may be over, at least on, if you think of it in terms of a pendulum, it's going to be swinging back the other way, where just in case is going to be preferred over just in time. And that lends itself to more demand for all those base metals, the atoms over bits and bytes that we've been talking about for a while now.
Yeah, resource nationalism is actually a buzzword now in markets. And I do think that after all, I think it's not about certainties when it comes to investing, it's about probabilities, and you have to have a balance between offense and defense within a portfolio.
Yeah, and I think we have that in place right now. Certainly if markets go ripping higher from here, we'll participate. But if they take a big nosedive, we should be fairly well insulated and slower to see decreases in capital in our strategies.
Absolutely.
All right, well, that's all we have for today. If you need any more clarifications, you know where to find us, and we'll see you next time.